Another portion, say pricing decision. So here in this chapter we are going to deal with how price is being determined. So as we all know, the term price, our pricing policy plays an important role as far as an industry is concerned, as the sole or lion part of an income of a firm is being derived from the price. The determination of price involves lot of exercises. If a unit or a firm fixes a wrong price, it will affect it in a long run as well as in a short run. So it should be very critical how it determines the price. Earlier, that is pre-1980s, it saw a more monopoly way of competition in the markets. There the prices were determined by the monopolist. The only decision was whether to increase the profit or not. So if he want to increase the profit, he have to decrease the price, or if he want to increase price, that is profit per unit, it has to decrease the output. That was the scenario before. But after that industrial revolution and all, the market scenario completely changed, and instead of that monopoly or monopolistic way of competition, it became a strict or a better competition in the markets. So hence the decision of the seller alone cannot be made while determining the price. So the market plays an important role here. So while determining the prices, the factors that are to be concerned, that are to be taken into consideration are, first of all, the cost. That is, any institution cannot survive without recovering its cost at all in a long run period of time. And second one, as we all know, the market situation. The market itself determines the price. In economics, we have already studied that in a market situation, in a perfect market situation, the demand and supply plays its own roles, and the market itself determines its price and the quantity to be supplied into that market. So the competition plays a vital role while determining the price. And third one is the competitor's price. How our competitors is going to make the price will also affect our pricing decision. So the three factors which affect our pricing decisions are, first one, our cost, second one, market situation, third one, competitors strategy. As we mentioned earlier, we cannot determine the price in a long run lower than its cost, because if the price is not capable of even absorbing its cost, it cannot go for a longer period of time. Second one, as we mentioned, in our new scenario, perfectly competitive market scenario, the market itself determines its price by playing with supplies and demands. So the market trend should be taken into consideration while determining the price. And third one, competitor strategy. So if we have to keep track on the competitor strategy, then only we can determine the price. So these are the three factors which is going to be taken into consideration before taking the pricing decision. Now let us analyze the principles. How we are going to price a product on the basis of these three factors. So here we are going to look into the factors into three, and thereby the methods of pricing are going to be analyzed on the basis of these three factors. So methods can be broadly like this, can be classified on the basis of cost, on the basis of market, on the basis of competitors. So first of all, the methods on the basis of cost. As we mentioned earlier, the cost is one of the major factors which is affecting our pricing decision, but it is not the alone factor. For the reason, the other factors such as market and competitors also plays a vital role while determining the price. But anyway, as we mentioned, a firm cannot run along without taking into consideration its cost of production. Hence, on the basis of cost, what are all methods that are prevailing in the market can be analyzed upfront. So first of all, on the basis of price, cost plus methods are being adopted. So what is cost plus method? As if cost plus method means the pricing scenario is such a way that the price is equal to cost plus certain percentage of profit. It's a simple technique. So in order to determine a price, the firm have to add a certain percentage of profit along with cost in order to get the price. So this system of price fixation is known as cost plus pricing situation. So what are all the advantages of this system? The advantages are that it is a fair method. Fair method means by determining the price through this method, the firm can earn a fair amount of profit. So there is no confusions that whether the firm will be capable of earning profit or not. There will not be such a scenario. So that it's a fair method of pricing. Second one, assured profit. As I said earlier, there is no question whether the firm will end up in a loss. For the reason, it is going to recoup all its costs along with a certain percentage of profit, so that the management is not at all worried regarding the profit as such. For the reason, the cost along with profit is to be recovered by the pricing strategy. And the third advantage is that it reduces risks and uncertainties. Reduces risks and uncertainty. This is on the point of view of the owners. So the owners will not get uncertain whether they will be getting profit or not, because the price itself is going to recover all those costs along with profit. Next one, it considers market factors. Considers market factors means even though the price is solely based on cost, the firm will try to compete with the market price so that the cost can be reduced to such extent, so that it considers the market factors also. So these are all the advantages of fixing the price through costing, that is cost plus pricing method. That is, it's a fair method. Assured profit can be guaranteed. It reduces that is risks and uncertainties, and it considers also the marketing factors. So let us analyze what are all the disadvantages of the same. For any policies, there will be some advantages along with some disadvantages. So let us analyze those disadvantages. While analyzing those disadvantages portion, first of all, it ignores demand. So while fixing the profit, we are not at all taking into consideration the demand for that product, so that if we charge this price by fixing cost plus, the company is not at all taking into consideration the demand that will be altered by fixing this price, so that it ignores demand. This is one of the disadvantages by fixing cost plus pricing method. Second one, it ignores competition. Ignores competition means, as we mentioned earlier, this is a very competitive world, so that the product homogeneous to our product will be available to the market. So if the same product is available at a lower price, the customers will go behind our competitors' product, so that we will be thrown out from the market. So the cost plus pricing system doesn't consider the competition effect at all. Third one, it ignores opportunity cost. Opportunity cost means here only the real costs are being taken into consideration. Real cost means actually explicit costs are being considered here. Implicit costs such as opportunity cost, that is, if we are going to sell the same to another product, those cost is not taken into consideration while fixing the cost plus pricing. So it ignores opportunity cost, that is, only explicit costs are being considered while fixing this pricing. All the other implicit, say all the other opportunity costs are being ignored while determining the price through cost plus pricing system. Next one, price volume relationships. Price volume relationship means PV ratio, that is, if the firm is going to increase its volume of production, it has to reduce the price, otherwise it cannot survive in the market. For the reason, only by reducing the price it can increase the quantity to be supplied. So here, if we are going to determine the price on the basis of the cost plus basis, it doesn't takes into consideration that price volume relationship, so that it cannot survive in the long run point of view in the market. So these are all the disadvantages while fixing the price through cost plus method, that is, it ignores demand, it ignores competition, it ignores opportunity cost, and it ignores price volume relationship also. Second method of pricing is rate of return pricing. Rate of return pricing means each firm have to be employed with some sort of capital, and while inserting capital into an unit, the owners of that capital will be wanting a certain percentage of return from their capital. So here, while determining the price, it is taken into consideration that how much the rate of return is being expected by the investors of capital. So say a firm employs 1 lakh rupees of capital into it, and the rate of return expected is around 12%. So on the basis of that 12%, that is 12,000 profit in this scenario, the price has to be sorted for. Say if we are going to incur a cost around 50,000 rupees, the price charged or the price income should be minimum of 62,000, then only it can get a profit of rupees 12,000. So while taking into consideration that total profit that is expected by the investors of capital, the price is being determined. This technique or this method of costing is known as, this method of pricing decision is known as rate of return pricing. Now the third method is nothing but variable cost pricing. Here in the first scenario, we took all the costs, irrespective of whether it is variable or fixed, we took it is completely into consideration there. So as in that disadvantages part of cost plus pricing, we mentioned that it ignores competition, etc. So if it is a hectic competition in the market, the firm can operate the price which could recoup only that variable portion in a short run. Even though this pricing strategy cannot be utilized for in a longer run scenario, it can very well be used in order to compete with these competitors by only recovering the variable cost portion. So here the price will be equal to the variable cost for producing the product. So this is the third method, that is variable cost pricing. Fourth one, competitive pricing. In the introductory section itself, we have discussed that the cost is not the lone factor which is determining the pricing decision. It is based on the competition also. Competition means, or in other words, the competitive pricing means the pricing strategy which has been used by our competitors. So rather than fixing the price, the firm is trying just to copy the price which is being charged by the competitor. So again, the competitive price can be classified into two: going rate basis and on bid. Going rate means the price which is charged by the competitor is being determined as our price also, and in bid, that is, in firm tries to keep its price as an average, instead of giving it as an average level of the industry, it is going to expect how the competitors is going to charge the price. There, on the way, expectation that the competitor is going to charge a price, it is going to bid a bit lower price than that of its competitors. In order to win that bid, it is going to charge the price lower than its competitors, while the price is being determined on the basis of bid, while in going rate basis it will be just equal to how the competitor is going to charge with. So these are all the methods that has been adopted. In short, in cost plus pricing, the price will be equal to the total cost plus certain percentage of profit. Here in case of rate of return of pricing, the price will be equal to the profit expected on capital plus the total cost to be incurred. Here in case of variable cost pricing, instead of getting into the total cost just variable costs are being recovered as price, this scenario cannot be applicable to a longer run situation, but it can be very well used in order to get a competitive strategy. Here in case of competitive pricing, the two methods are being used. Going rate, that is the price will be as if the competitor is going to charge, and at bid rate, in bid rate the firm is going to charge price a bit lower than what it expects a competitor to be charged. Now let us discuss about pricing strategies. Strategies of pricing. Strategies can be broadly classified into two: price skimming and penetration pricing. So these are the both strategies which are used while entering into the market. So while entering into the market, an organization, a company can either adopt skimming pricing policy, nor it can adopt penetration policy. Both these policies are opposite to each other. In penetration pricing point of view, first of all, the price charge will be lower. So these sorts of pricing policies are adequate if three conditions are satisfied. So what are all those conditions? Conditions can be: first one, demand is elastic. Elasticity of demand means the change in demand due to change in price. So if the price is a sensitive factor while determining the demand, this penetration price can be followed. Say, for example, detergent soaps. If the other units are selling a 100 gram detergent soap at rupees 10, if a new organization who is going to come into the market is going to sell it a bit lower than that of 10 rupees, say at rupees 8, every other customers will start to buy our product. So here, if the demand is elastic, that is, if the demand is insensitive with that of pricing policy, then penetration policy can be adopted. Second one, high competition. If there is high competition, the firm cannot adopt a higher prices while it is entering into the market, so that if there is a higher competitive effect in the market, if we have to capture the wholesome market, it have to obviously charge a lower price, then only it can go into same. And third one, substantial saving due to economies of scale or economies of scale. Say, by charging the lower price, the firm can capture a wholesome part of the market, and by that, if it can increase its volume of production, even though per unit profit margin is lower, as it can increase its volume of production, it can utilize the advantages of economies of scale, and if that product is capable of utilizing that economies of scale, it can adopt the penetration policy. So if these three scenarios are being present in the market, it can adopt for penetration. So in penetration pricing policy, pricing strategy, first the firm will price the product at lower prices, then after capturing the market, it will start increasing the price so that the competition will be lower as the firm have actually captured the wholesome market. So if three conditions are there, it can easily go for penetration pricing. In opposite to this penetration point of view, there is another policy, namely skimming pricing strategy. So in case of a skimming pricing strategy, upfront it will charge higher price, and after that it will start decreasing its price lower and lower and lower. So these sorts of strategies are applicable if the firm is incurring higher pre-incorporation expenses. That is, if a newer technological product, say a computer laptop, a computer software, mobile phones are being introduced here, it can adopt for skimming policy. For the reason, the research and development expenses, pre-incorporation expenses will be more than comparing with these locally available products, so that to recoup all those technology, or if it doesn't charge higher price up front, this technology will be copied by the competitors also, and they will start producing the very same technological products. Hence it cannot recoup all the products, all the cost which has been incurred during the research and development stages. So if it is producing highly technological, having high pre-incorporation cost, research and development cost, etc., it can opt for skimming price. And if the demand of that product is inelastic, in this scenario also, say the price charge will not affect the demand at all. In that scenario also, it can go for a skimming policy, as it was opposite in case of penetration policy. There we adopted for penetration policy as the demand for that product is having elasticity or is sensitive to its price charge. But here, if the price charge have got a least effect in its demand, then the firm can go for a skimming policy. So in opposite to this penetration policy, the firm is going to charge a higher price in case of skimming policy, and after that, during further stages of its life cycle, it is going to decrease the value. So these are the two strategies that can be adopted while entering into the market, that is penetration strategy along with skimming. Next topic, price discrimination. Price discrimination is nothing but price is being charged differently for different sets of people. So the methods under which price discrimination is taken is on the basis of the customers that the product is going to be sold, on the basis of the product version, on the basis of the place, and on the basis of time. So on the basis of all these factors, the prices are being discriminated. Discrimination is nothing but charging different prices to different sets of people. So let's analyze it in customer's point of view. Say if the same product is charged at different prices to different customers, the price charge should not affect that customers relationships as such. So without affecting that customer relationships, it can be given at different ways. Say for example, a company is going to sell it to the wholesalers, to the retailers, or to the customers as such, the final consumers as such. It can charge at different rates. So say it can charge lower prices to wholesalers, a bit more towards the retailers, and it can charge even at MRP rates to its final consumers. So on the basis of the customer to whom the firm is going to supply the same, it can discriminate with the price, but the only relevant point is that it should not affect the customer relationships. So on the basis of the product version, price discrimination can be made. Say for example, the firm is going to manufacture a wooden desk. Say if it is going to manufacture a wooden desk, it costs around 100 rupees, and if you want to get a 50% profit, it is going to charge at 150 rupees. So an ordinary bench, it is going to get rupees 150 from single bench, and if it is going to cover the same with mica, it can earn a bit more, that is say 250 rupees. Even though the fixing of mica won't get into 100 rupees cost, the version of that product, that is product without mica and with mica, has been made, so that the change in the quality, the change in the deluxity of the product, on the basis of the product version, prices can be discriminated. That is, even though the discriminated, that is version of product, for changing the version of product, the cost doesn't incur that much, even though it can increase the price on the basis of the production version. That is, in case of just as if we had made for the furniture with mica and without mica. And as on the basis of place, the price can be also discriminated. For example, in a cinema theatre, those who are sitting nearer to the screen can be charged lower, and who are on the balcony seats can be charged higher. So on the basis of the place at which the customer is being placed, can be on the basis, can be a basis for determining the price. Say in a cricket stadium, those guys who are sitting nearer to the pitch, say to the gallery seats, can be made, or pavilion seats can be charged at higher rates than that of who are sitting in balcony seats, who are far away from the pitch as such. So on the basis of a place where the customers are being placed, the price can be that discriminated. Last one, on the basis of time. On the basis of time means on the basis of season. Say for example, during the summer season, the prices for fridges, air conditioners will be relatively higher than comparing with winter or rainy season. So that on the basis of time, the price can be discriminated. Say during those non-peak hours, that is non-peak time, that is during the winter season or something like that, the prices will be inclusive of various discounts and other promotional activities. Hence, during the off-time seasons, prices will be charged lower. So these are all factors which determines the price discrimination. The price discrimination on the basis of the customers, that is to whom the firm is going to supply the same product version. The higher deluxe product will be sold at higher rate, even though the cost for making it into a higher doesn't have that much difference in that of the pricing differences. Third one, on the basis of place, just as if we mentioned in case of a cricket stadium or in a cinema theatre, on the basis of where the customer is being placed, that is the place of the being the service provision, the price is being discriminated. Fourth one, on the basis of time, during off season and during the peak season hours, the price will be get discriminated. So these are all price discrimination factors. After that price discrimination strategy, let us discuss about geographical pricing. So as we discussed earlier, prices will be charged discriminately without effect in the customer relationships. Just like that, on the basis of geographic features, that is the place features, the prices are being charged differently. So for example, the classic example for geographic pricing is for the petrol. The rates for petrol will be different within a state again, or with that is, say for example, a petrol pump situated nearby to a port will supply a lower rate than that of comparing with a petrol pump situated away from the port, because the price is inclusive of those freight charges. So this freight or that transportation expenses will be included in various places at various rates, so that the pricing according to the geographic situations will vary one point to another. So on the basis of that geographic pricing, the total pricing strategy can be classified on 4 types. That is on the basis of point of production basis, uniform delivery basis, zonal delivery basis, freight absorption basis. So first of all, point of production basis. So here, when the price is being determined on the basis of point of production basis, there won't be any differences between the price charged to various customers. That is, the price charged will be equal for all the customers, and the price which has been, or the cost which has been incurred in order to produce the product at factory along with certain percentage of profit will be charged as price. So if the point of production strategy is being followed, the client will be asked to pay the freight charges separately. So the freight charges which has been incurred differently for various clients on the basis of their geographical location won't affect the price at all. So in case of point of production pricing, the price will remain the same and the freight will be asked to be paid by the client directly. So in case of second method, uniform delivery method, the total equalized freight will be divided along with the price equally, and it can distribute, the firm can distribute irrespective of the geographical situations at the same price, same product to every customer situating whole in the area. So that here also geographic factors doesn't affect our price, and price will be uniform throughout the states. Third one, zonal delivery. Here the total market will be classified into various zones and prices will be same for each and every zone. But it can change from one zone to another, say southern zone, northern zone, west zone, east zone, etc. But for if we take a zone as such, the price charged will be uniform throughout that zone. That type of geographic pricing method is known as zone delivery pricing. So here the freight for providing it to each zone will be added along, and the average rate of freight will be charged with each price which is going to be charged in each zone. Fourth one, freight absorption policy. In opposite to this point of production policy, where it is only going to charge the price as recovering the cost for producing, not including the freight, and the freight is being paid directly by the client. Here in this case, freight will be included in the price and it will change according to the geographic situation of the client. So this technique is just opposite to our first point, that is point of production technique, and here the freight is being absorbed along with the price, so it will vary from client to client. So on the basis of geographic pricing, it can be classified into 4 types: point of production technique, uniform delivery, zonal delivery, and freight absorption strategy. Let us move on to some problems. First one, an organization manufactures a product and the particulars of the production has been given below. Total production 20,000 units, cost per annum, material cost rupees 50,000, variable cost 60,000, fixed cost 40,000. Total investment 50 plus 60 plus 40, 1,50,000. The question is, determine the unit selling price under two strategies mentioned below. Assume that tax rate is 40%. So under the prevailing tax rate, that is at 40%, we have to calculate the price to be charged if 20% of return on investment is being expected by the investors. First one. Second one, 6% profit on list sales, that is 6% on sales by providing discount, trade discount at the rate 40%. So these are the two questions to be answered. First of all, we can determine the price so that it can earn 20% return on investment. So here it is clear that total investment is 50 plus 60 plus 40, 1,50,000 rupees, and the expected return is around 20%. Expected return at the rate 20%. So this is rate of return expected on capital employed. So which is 1,50,000 into 20% is 30,000 rupees. So rupees 30,000 is being expected as profit by investing 1,50,000 rupees. So the question is that how much should be the price that should be charged in order to get a profit of rupees 30,000. So here the prevailing tax rate is around 40% and after tax profit. So this must be the after tax profit. So after tax profit, that is